Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by returning guest Dr. Nomi Prins, macro-economist, geopolitical financial expert, and best-selling author, and also the founder of the fantastic Prinsights with Nomi Prins over at Substack. I highly recommend you give that a subscribe. Dr. Prins, welcome back to the show.
Thank you so much, Robert. I appreciate you.
Always a pleasure to speak to you. We were just saying off air, the last time we spoke, I think was 9th or 10th of April. And in that time, the Dow Jones went up and down by about 3,000 points. So I'm hoping that nothing as chaotic happens today. We're going to talk about gold and copper and the supply side mechanics. But as I've just mentioned, the Dow Jones, let's talk about the state of the US markets in general and maybe bring the Federal Reserve in. Do you think with the markets and the levels that they're at the moment, that a rate cut on the 10th of December is already baked in, or do you reckon there's some other things going on there?
Yeah, I think it is. There was a little bit of sort of debate a few weeks ago as to whether or not they would have an additional 25 basis point cut this year before they head out for the year. And Jerome Powell, of course, at the last Q&A session after the last meeting had suggested that it wasn't a foregone conclusion. And that kind of caused some pause in the markets to say, well, maybe he means it, maybe he doesn't. But I mean, the reality is we are still looking at a labor market with unemployment rates actually higher than they were at before going into the COVID period, which of course changed dramatically what was going on in monetary policy in terms of more QE, rate cuts to zero, and so forth, and then all the inflation shocks that followed, and where we're at now with monetary policy. But the reality is we are still at those levels. The labor market is still seeing issues coming in, still layoffs coming about, and I think that Powell will not want to push too hard with a semi-fractured set of Federal Reserve governors to not have a final rate cut for this year. So I do believe we're still going to have that 25 basis points cut. If we happen to get a hugely weak unemployment report or payroll report this Friday, that might change and they might go to 50, but that would only be if we had a tremendously weak print coming. And I don't really see that, but that would potentially move them higher. But otherwise, I think we're going to get that 25 basis points. And I think the market thinks that as well.
I know that you've recently written as well that you, regardless of who becomes new Fed chair, and we'll talk about that in a second, that you and your team are predicting that there's likely to be 100 basis points cut in 2026. Why do you think that would likely be the case?
Well, basically, the administration, and by that, this is really a Trump administration and a Treasury Secretary sort of want, is to do something with the payments of the interest rates on our massive amount of debt. Over $38 trillion more interest rate payments on an annual basis, touching around $1 trillion. I mean, these are substantive sums of money. What that means is that $1 trillion basically goes out the door of Washington before anything happens with regard to policy, with regard to economic growth, with regard to even the defense numbers. And so that's not changed in the last period since Jerome Powell has been head of the Fed, except for the fact that it's only increased and gotten worse. And now, if there's a chance to replace him, which there is because his term is up in May 2026, we're going to see a far more dovish policy had in that monetary policy seat running the Federal Reserve. And so whether we get to 75 or 100 basis points this year, and I think it's going to be 75 for the year, I think we're still starting at that concept, those levels going into next year, specifically over the second half of the year, as we also get towards midterm elections. So even though we like to think of the Federal Reserve as being independent, and legislatively, it is an independent body. The Federal Reserve Act of 1913 created the Federal Reserve with 12 banks in the Federal Reserve System, the idea of which was to focus on the regional effects of policy and regional economic and policy balance, and the idea of having liquidity in the system. But what we have now really is, especially if we get a new appointment, which we will from the Trump administration that's more dovish, is a very close link to the legislative and economic, I mean, so an executive branch side. And what that means is, especially with Congress currently favoring Republicans in terms of numbers, which basically has to vote to approve the nominee of the president, it's likely to get approved, and that will likely be more dovish. All of that points to higher interest rate cuts to get some of the cost of managing that debt down a little bit for future debt. It's not even really going to help current debt, but at least for future debt, and the possibility of more quantitative easing. We've already seen quantitative tightening stop as of the last FOMC meeting. And even before it officially stopped, it was kind of trickling down. It was significantly slowing in terms of quantitative tightening or the rolling off of bonds on the balance sheet of the Federal Reserve. So I believe we're going to see something that looks like quantitative easing, whether it's officially a quantitative easing program or whether it's sort of more work in terms of the reverse repo or the other facilities the Fed has at its disposal to ensure more liquidity in the banking system, or some sort of a buying program from the Treasury Department. We're going to see more of that sort of monetary policy come out as well.
I see that there's a variety of names bandished around about who could become the new Fed chair come May 2026. But is there anyone in particular that, as an investor, we should be, I don't want to say looking forward to, but are there any names that stand out that would have implications moving forward?
Well, I mean, there are some. I mean, Kevin Hassett has been one that's been batted about. We could see someone from inside the Treasury Department actually that hasn't been batted. I feel that they're, and we saw this a little bit with some of what Trump did with the FOMC governor's open seat, is that it's not always the person that's basically batted about in the press. It's kind of potentially somebody else. And I could actually see, and not to name names, I don't know who it would be in the Treasury Department, but I could definitely see that it would make political sense to move someone over who's close to Scott Bessent, who understands the Treasury Department's MO and wanting to also do something with that and align with the White House, that we could see some sort of a candidate coming, or possibility coming from inside inside the Treasury Department.
Fair enough. So in summary, then pending data that comes out on the 5th of December, we should be looking at 25 basis points cut in December, and then certainly with a new chair from next year, that's likely going to take it towards a more dovish stance, which means that we're likely to see those rates drop in 2026. What impact then will, and we'll get onto gold and whatnot in a bit, but what impact will that have on, say, for example, the S&P 500 in terms of a short to medium term outlook?
So the S&P, which we've seen get to historical records yet again this year, is very much a follower of cheap money, whatever that looks like, whether that's expectations of rate cuts in the front end, whether that's low interest rates throughout the curve. We have seen the 10-year and 30-year come down a bit, but not as much perhaps as if we had additional sort of QE type or Treasury buyback type of programs filtering in through the market next year. So if we do see all of that happen, or any of that happen, more so, the S&P is going to be very happy about that. What that simply means is that the value of equities relative to the value of yields on debt has more upside, and the value of borrowing debt, because yields are lower, is cheaper than not. This continues to amass debt. I mean, any of these programs will not mean an end to the growth of debt, but it does make the attractiveness, or the relative attractiveness, of the S&P 500 and the leveraging of cheaper money more of a sustainable, than it has even been this year, more of a sustainable policy. So I think any form of easing that we see is going to translate, that's even expectations of it, or some of it has already happened, has done, into higher S&P levels. This doesn't mean we won't have more volatility. This doesn't mean that, as we head into the election, there won't be things that can happen from the standpoint of party to party Party and expectations of what could happen in the midterms that could give the market pause. It doesn't mean that every single earnings print that we see is going to be positive in and of itself. It doesn't even mean that NVIDIA or some of the AI stocks are going to reach much past their recent highs, although I actually think they will push up against over their recent highs. But it does mean that in general, the market will continue to rise.
And I think that that's also important, as you've mentioned, the midterm as well. I'm sure that if people are going to the polls next year and they can see that markets are at nominal highs, etc., again, it's just that, regardless of concentration risk, it's just that feel-good factor, and then that could also help to enhance the majority in the House and the Senate, which would also be very important then for the next 2 years and beyond. So there's all these political cards at play.
No, that's exactly right. And it goes back also to if we do see, your earlier question about monetary policy easing or any of that, as well as rates coming into a new Federal Reserve chairperson, that helps. And again, it still amasses debt. It's not necessarily stabilizing long term for an economy, but it does make people feel better about the debt burdens that they already have.
Yeah, kicks the can down the road a little bit longer, so to speak. All of everything you've just mentioned is obviously very good for gold, and we've seen gold, on a tear in the last 18 months. And again, we'll get into the supply side because I think that's important to talk about. But again, just in general, what have we seen happen in gold? And again, is that just going to be a case of onwards and upwards because that links to everything else that you've just gone through?
Yeah, I mean, what we've seen is a real acceleration of the appreciation of gold that we saw basically from the beginning of 2022, when central banks, on the wake of sanctions against Russia for escalation of the invasion into Ukraine and so forth, got concerned about and not for the first time, but basically, looked at their policies in terms of concern about whether it's possible sanctions to them in the future for something they've done, whether it's simply wanting to have a consolidation of monetary policy that isn't dependent on the dollar, not dependent on U.S. Or Western policy or whatever was the thinking to that. We saw a beginning of an escalation of gold being bought by central banks, and that filtered into markets and so forth. But this year, as you mentioned, it did really increase for a lot of reasons, and we've seen a 60% upside in gold just this year or so. It's been a phenomenal increase considering that it was already sort of inching up, and that's predominantly because there has been more central bank buying. We are heading into the fourth year of increased or record buying. There is more of a percentage of reserves relative to the dollar that are now in gold in terms of global central banks. So there's been that tipping point that has happened just earlier this year in terms of more gold being in central banks relative to the dollar. If we were to zoom out and if gold were actually considered an official currency relative to other types of fiat currencies, gold would be second to the dollar, and it would be more of a holding than the euro in terms of percentages, which was second. So we've seen this sort of evolution of the dollar really coming to the forefront of not just central bank buying, but the policies that have pushed that buying. And there's no geopolitical reason to assume that any of the nations stockpiling gold right now in order to have that additional sovereignty or additional control over how they process their trades with each other or their trading flow with each other going forward to change that and to just all of a sudden dump their gold. The reality is what has been happening alongside that increase for central banks is more development and payment systems that will be able to have gold be a component of them, if not settling gold. Not trades actually settling in physical gold, settling with currencies that are backed by physical gold at their central banks and in their financial systems. So the technology is growing to accept gold in trading, to accept gold as that monetary second policy pillar of how central banks operate. And we're going to continue to see that. So that entire push is going to continue into next year and going forward. But what's also happened this year is the retail investor has come into gold more. So last quarter was the first quarter in this entire bull cycle, or the first phase, I'd say, of the bull cycle of gold up through almost 4,500 now. uh, to come on board and actually buy more gold ETFs that are backed by gold, that then also have to then go out and buy the gold to be able to sort of back their upside and their additional volume and so forth. And we've seen that Western buyer come in because they've been reading about gold. They've been talking about gold at their dinner tables. They've been asking, why don't they have gold in their portfolios? And then you get on top of that, companies like Morgan Stanley, and they will not be the first one saying, you know what, we've just had to think about it. And, we're going from this idea of an allocation of an investment portfolio from 60 to 40, 60% equities, 40% bonds, into 60-20-20, where that 40%, just like central banks, sort of divides again between having a bond position or a debt position, really, and having commodity position or a gold-led position. And that entire movement hasn't even really happened yet. We're still looking at 3 to 4% on average on the high side, for retail investment in gold or in commodities or in mining companies, which is a very tiny sliver of that, that basically supply into these commodities. So all of that allocation has yet to occur for gold. And so for next year, we're looking at a 6,000 level on gold for the end of the year. Again, there can be volatility on that. There can be up and down sides, but that's actually a smaller percentage increase than we had in 2025 on the back of where gold is, with a lot more demand coming into the market.
Yeah, there's so many factors at play on the demand side for gold that make it incredibly strong. And just going on to the point you just made there with 60-20-20, all we have to think about is the amount of hedge fund managers or family offices, for example, that might not have an allocation, that now, especially in a hedge fund point of view, that are going to need an allocation. And if they go out and start accumulating, ETFs, for example, that's likely to be very sticky demand as well. They're not going to be chopping and trading because they're going to need to take a long-term view. So that again just adds to the demand side here.
Yeah, and also the other set of actors in this are pension funds and large insurance companies, because they can't, for example, just make the decision to buy gold. There have to be regulatory restrictions that have to be sort of removed and replaced in order for them to be able to increase their allocations, for example, to gold. And a lot of that is starting to happen because of where gold is now positioned in the world in terms of investments, net of the central bank side of it. And so that whole sort of additional set of demand players for gold is just kind of beginning to position now. And we're talking about, tens of trillions of dollars, not necessarily all flowing into gold, but potentially repositioned into some gold, once those rules are set into place, which are happening throughout the world. And that's going to be another set of demand.
I should also point out that it's not even just central banks buying gold. I understand that Tether has a 116-ton gold hoard, which puts it on par with South Korea, I think, and Hungary as well. So it's not even just the central banks as well. It's, other major institutions really taking positions here.
That's right. And central banks are actually, they might have accelerated the most relative to other pockets of demand across the gold spectrum, but they're actually not the major players. They're just the ones that are, well, I think more interesting, but geopolitically, for all the reasons that they are amassing gold and will continue to amass gold, but they're not even the largest players. They're maybe 20 to 25% of the market. So I mean, you have an entirely other set of market players continuing to increase their allocations to gold.
So just to summarize on the demand side, we have a 60-20-20 portfolio suggestion now. We have Western retail seemingly waking up. We have a likely more dovish Fed, which is going to be some, forms of QE, etc. So all of that's good for demand. We've not even spoken about supply. So let's get on to that, because this is something that you've highlighted in a recent article. I'll link to that in the post as well. That all the demand is great, and that's going to, in my opinion, push up the price a lot higher. But actually, there are some significant supply challenges within gold at the moment. So, what's going on there?
Yeah, so I mean, in general, gold has to come out of the ground or from a mine, and to bring any new mine online can take anywhere between 10 and 20 years. And what I'm saying by that, it's in terms of excavating, making sure that the quality is there during all the, initial feasibility tests, ensuring permits are in place to go further than that, ensuring the geopolitics or the regional risks are restricted sufficiently to continue to basically process gold from the ground and sort of bring gold into supply. So what we're looking at now is there are very few new gold mines coming on board in terms of the next couple of years. There's certainly mines throughout the world that can come on board that are in various processes of permits. For example, in the United States, there are a number of mines on the western coast which have really popped up in terms of processing permits just in the last year or two, as we've seen gold prices escalate, as it makes more sense to dig, to excavate, to search, to permit, and go through that entire process. So there are background sort of suppliers that are going to come onto the market that are just in the very initial stages in geographies that had perhaps abandoned some of their gold searching, and that's been coming online in the last couple of years. But that's the tail end of supply. You have the large suppliers, of course, the large companies, your Agnicos, your Newmonts, and so forth, that have gold mines operating throughout the world already, feeding into new supply and constantly looking for new mines coming onto the market. But you also have all of these miners, junior and sort of slightly bigger than junior miners, who are at various stages of a long-term development cycle in terms of getting gold from the ground, and high quality gold from the ground into bars, right, into coins, and into sort of the end product. And there is a lack of that supply coming online relative to what the demand is. And just like with anything else in economics, the quicker demand moves, the more of a strain it places on supply, and therefore the more prices go up in terms of what is already out of the ground. And that's part of also what we're seeing. We have seen a lot of the miners do very well this year, the bigger miners who actually have regular supply and everything's all sort of up and running and permitted and high quality and all of that, as I've mentioned. But we also have a sort of gap in terms of how we're going to fit the next level of supply based on where other mines are throughout the world. I mean, gold does have a lot of span throughout the world. I mean, we do have mines that can be tapped in, that have permits that can be perhaps accelerated, but there was still there is still a time element that right now gold is basically bumping up against. And that's also one of the reasons why this year I think we're going to see more of the mines that are closer to production be bought, or the miners that own those mines be bought by the bigger players, because what's happened is they've made money off of gold prices being where they are. They have more cash on balance sheet, and they're routinely scouting the world for where the mine sites are, where the infrastructure is strong, where the jurisdictions are neutral, and where they can basically buy those mines up and add them to their portfolio. So I think we're going to see a lot of those larger junior miners come into the umbrella of the bigger miners, which is going to give them a pop. I think they've sort of lagged the market, and that's how we're going to try to start to close some of the growing future gap of gold relative to gold supply.
Well, just relating to that article that I mentioned, and you wrote in here that global mine supply is sitting around 3,700 metric tons for 2025, and that's possibly 1% up from 2024, but it's basically flat since 2018. So again, we've got all of these demand factors, and yet on the supply side, it's possibly a 1% increase, but flat from 2018. So again, I always say economics 101, that's going to indicate that price is ultimately going to have to go in one direction, and it's not down.
Right, and also as that price does go up, it does potentially make it more attractive to speed up the development of mines in process. because you have that extra capital. You have, as I mentioned before, the larger mining companies coming in and sort of helping to finance projects that are closer to being realized, and sort of that brings up the chain in terms of that supply gap. But the fact is, we've had all of this appreciation in, as you mentioned, in the gold price, and we haven't had this real growth at all, pretty much, in the supply side. And that goes back to what I was saying before. On the one hand, it takes years to bring a site to market, let alone even a mine that's, semi-permitted to market. And the value is there, but you can't squeeze the time, or if you do, it's only by so much. And I think what we're going to start to see more so this year is finally a bit of the catch up for those mines that are closer to producing supply by getting injections of capital because of how high prices are. But again, that takes time, and all of that squeezes up prices in the meantime.
And it's not just gold that's happening in. I know that behind the scenes we've been doing some work and research on the PGMs. So we've seen that there's a small physical deficit in palladium. There is in platinum, although that's recently forecast to be a surplus for 2026. Again, copper as well. So it's not just gold. I should mention silver because I'll get lambasted if I don't mention silver. So again, all of these critical minerals, they're all looking like they're facing supply deficits, which again isn't very good, but could be quite useful price-wise moving forward.
Well, that's right. I mean, if we start with silver, for example, and the spread from silver to gold has contracted a lot this year. Silver has outperformed gold this year in terms of price. Of course, it is the more volatile of those two metals, but what we have seen significant increases in silver for those very reasons. There is the dearth of supply in silver, about 200 million ounces per year below the demand for silver, and same thing there. You're not going to have mines that are just going to come on board in 6 months or a year because there is a need for that extra supply. I mean, these are things that again take time, and it's one of the reasons why similar with gold, probably more so with silver, that junior miners in areas with neutral jurisdictions and more streamlined permit processes and better infrastructure to work the mines and to bring product ultimately to market are going to be the ones that are going to outperform because we need the silver, and B, you're also going to have the larger companies that do have the additional profits from the higher prices and silver riding on their books, going out and scouting for how they can help the junior miners that are more upstream, that they can bring into their downstream or in their production cycle. So we're going to see in the meantime, though, that time versus supply gap, which is going to squeeze silver prices higher as well. It's, you mentioned platinum and palladium. Platinum, yes, does have a surplus forecast, but it's tiny, and it only takes one mine basically, or one additional mine to be disrupted. And for example, South Africa, where there's certainly been a lot of issues with mines there, or in Russia, where there's geopolitical and other logistics constraints in terms of bringing out platinum into the supply chain, to change that surplus into a deficit. And either way, we're still looking at an increase in demand in terms of more hydrogen delivered technologies and in energy and so forth of that platinum. So that's going to continue, I think, to squeeze those prices up. And copper, we have seen hit 525 this year. There's a bit of a dearth, and not a dearth, I'm sorry, there's a bit of a dip in copper prices in the middle of the year, and the world was like, you see, growth isn't happening as fast. China's not growing as quick as it said it was going to grow. All of a sudden, there's no need for all of the copper it's stockpiling. But that basically, that whole argument dissipated, because the reality is there is still a major copper demand for all of the electrification that continues to happen in the world with respect to upgrading energy across the world, and sort of energy movement across the world. That's not going to go away. And copper is similar in terms of it still has a very long-term process to get into the official downstream supply chain. And so that's one of the reasons we've been very bullish on copper, and we're very bullish on copper for next year, because of that additional demand from electrification. And it's not an accident that the latest critical minerals list that came out from the White House, from Capitol Hill in earlier November, put copper on it for the first time, put silver on it for the first time, expanded platinum and palladium, and other of those metals were on it, as were the 17 rare earths and so forth from prior lists. They stayed on. Gold is not on, actually, which is interesting to me because it's not considered a defense related material, just has all those monetary elements to it. But it would not surprise me if the next critical minerals list actually also included gold. But the other ones, they're there, and they're there for a reason. They're there because there simply is not enough supply in North America, in the West, to compete with the demand here and the demand throughout the world, and the supply that's happening and the production that's happening across the world.
Well, I think it's important that we've gone through the demand and supply factors because I know that there's, I know at the back end of last week, it's Monday the 1st of December, I should point out just for a date stamp. I know there's been a lot of excitement or shenanigans in silver, from Thanksgiving and Black Friday to where we are now. And I know it's very easy for people to get emotionally very excited about $57, $58. I understand that. But my point is it's been really good to go through the demand and supply because we can step back and go, we can ignore the noise because the basics are saying no matter whether you're looking at demand or whether you're looking at supply, that actually all the factors that you could think of that you would want to have for a much higher price, they're all in play and it looks unlikely they're going to change anytime soon. So onwards and upwards in the long term, pretty much is what we're going to see here.
That's right. And yeah, there was certainly a very accelerated squeeze up in silver prices over the holiday, and there is silver has sort of always had or at least recently with the financialization of how banking works and how ETFs work, and how markets can to an extent be manipulated with large orders here and there. I think that's really we may have seen the last of that, even if that is what happened to an extent over Thanksgiving, because the reality is that the economics of supply versus real demand for silver, and that includes demand also in electrification, also in solar panels, also in the strengthening of data centers in terms of the infrastructure that's needed to produce enough supply of energy into them and so forth. These are things that require more silver than we actually have. And so you can move things about in thinner markets, and we do see thinner markets around the holiday times, simply because there's more trading going on in a concentrated manner in certain sectors or in certain names, or in certain commodities. But, as you just said, and I agree with, that the reality is that if you step back and look at the demand, the basics of economics, demand, supply, and throw onto that the basics of geopolitics and jurisdiction, because it is a big part of it. When you have risks in certain mining jurisdictions, when you have sanctions across certain components of commodities coming from certain countries, whether that's Russia or potentially South Africa. I mean, clearly there's been some issues with what is with how the with how President Trump views South Africa. It hasn't filtered into platinum, but these things can happen as long as we're in a world where there's geopolitical risk, there's jurisdiction risk, there's on the ground risk in terms of just the sheer technologies and logistics of mining, and there is a supply dearth relative to multiple avenues of demand. Ultimately, there is one way for prices to go, and there's one places for the miners that best feed into that. Not every miner who supply the initial components of the initial pieces of those commodities fit into these things as well. So I think in a way, when we see these quick squeezes in something like silver, it's a little bit of a reminiscent of the past where you could do that more frequently and come down more frequently. And it's not that it's not in the market anymore, but I think ultimately supply and demand in these commodities, including in silver, are going to be what drives prices. And either way, those prices are still going to go up because of that ratio.
And just one thing to add to all of that, and I know we've mentioned about jurisdiction risk, geopolitical risk. It always looks like no matter what forecast, no matter who's forecasting X, Y, and Z, that there's never a contingency that's put into these records either. So, as you said, all it does take is an issue with South Africa or something with Russia, dare I mention Venezuela, and then all of a sudden the proverbial could really hit the fan as well, and that's none of that's accounted for.
No, exactly. If you look at something like Argentina, which has made some very interesting shifts in its policy with regard to oil, with regard to silver, with regard to mining, that are positive for sort of removing jurisdictional risk. At the same time, that could reverse. I mean, and not to just pinpoint Argentina, but countries that actually are sort of moving into these spaces, or changing their policies around some of the natural resource spaces could change the next day as well. So it's yes, I totally agree. There's a lot of things that you need to look at from the standpoint of geopolitics, and it is also why when we look at Prinsights and all the work that I've done over the years, look at the investment side of all of these equations, and the economic and geopolitical side, is that you can't avoid those two other factors. If you're looking at any investment in a commodity or in a particular company that's on some part of that upstream to downstream supply chain for that element or for that commodity, you have to keep in mind so many different factors, I think, to get to make sure that you have the full picture of the risks as well as the full potential for the upside.
Well, we've definitely covered a lot today. We've started by looking at the Federal Reserve and the outlook potentially for the US equity markets and so forth. We've then shifted across to not just gold, but we've looked at all the demand factors, supply factors. We've covered a range of different elements. We haven't even mentioned uranium and oil yet. But is there anything that we haven't mentioned that you would like to bring to the listeners' attention before we wrap up?
Yeah, I mean, you did just because you mentioned uranium, and obviously that's one of our main themes, and I've been very close with different sort of policy shifts in the United States and throughout the world with respect to nuclear power, to SMRs, to the technology around small and micro reactors in terms of bringing of that base load nuclear energy into the areas where it's most suited and most necessary. And I do see uranium, of course, is back on the critical minerals list. It left for a second. It was on the first one in 2018 when it first came out. So that's back in play. But I definitely see upside for uranium as well, particularly as utilities that have locked in old uranium contracts for their nuclear power sites on higher levels, well, the levels that were higher in sort of the 80s. And now that prices are starting to move into that area on the spot side, I think we're going to see the renewed contracts come in much higher. So we could see new contracts next year being pounded like $100 in terms of uranium, and that's going to bring up the spot side as well. So I see upside there, and that's going to, just like with these other commodities that we're talking about, that's going to bring mining projects that are closer to fruition, and production facilities that now also have federal and other national funding behind them more so than they had before, into the forefront. So I see upside across both of those, again, being careful of jurisdictional and other types of risks. In terms of oil, I'm never generally a fan of investing in oil, mostly because I think it's obviously prevalent in terms of energy, but the geopolitics of oil is actually quite spread out, and the supply of oil is quite static to an extent. People will talk about peak oil, not peak oil, etc. But the reality is, oil is sort of a mature commodity relative to some of these other things about shifts in energy and infrastructure, and in AI and data centers and so forth. So I tend to not really see much upside in oil prices, except for the usual, cyclical things. If there is a summer, if there is, an obscenely cold winter, things like that tend to bring up prices, sort of periodically, cyclically. And of course, any event that could happen in the Middle East and Venezuela or so forth that might have a sort of immediate impact on oil prices. But in general, I kind of see them pretty stable to even lower than where they are now.
Well, on that note, I think that's a fantastic place to wrap up. As I mentioned, we've covered a lot of ground. I also mentioned a couple of articles that you've recently penned as well. I'll link to them in the post that comes with this audio and video. I always like to give everyone the opportunity to tell how you can be found. Again, I'll link to all of this in the post as well. But if people want to contact with yourself and your team, Dr. Prins, how do they do that?
Yeah, no, I appreciate that, and thank you for this time. The best way to follow us along or subscribe to is prinsights.substack.com. In addition to complimentary research and material, we have two major products that look at both the junior side of mining and commodities and technologies in that sector, as well as on the more sort of mid cap, larger cap investment strategies that we see as being a part of moving all of this forward and where there are investment opportunities. And we have different price points for those products. But I encourage everyone to check it out. Next year is going to be really, really interesting. A lot of movement in a lot of these areas we've been talking about. And I'm pretty excited about the year to come.
Likewise, and I think that we should aim to catch up in and around May time, as and when the new Fed chair is announced, and we'll see what the lay of the land is then. As mentioned, highly recommend you go and follow Dr. Nomi Prins and the Prinsights team and her work. I'll link to all of that in the post as well. Thank you again for your time. Have a great Christmas and catch up in 2026.
Thank you.